Hey, this is Sasha, and welcome to another episode on Hungry for Returns. In this week's episode, we're going to take a look at iron condors versus butterflies when it comes to option trading, and are they really useful? So it comes from a question of a viewer here, and if you have a specific question that you want answered regarding trading, investing based on my own personal experience, then submit a question at our website at tradersfly.com. Now you can submit one by writing it in or do it by voice. So let's take a look here on screen. Here's the question. Do you like iron condors and butterflies? I don't see them being useful or effective. So that's kind of the question, and I want to show you how useful and effective these things can actually be. So let's go to the screen here and check this stuff out. Now, to get things started, remember, you got to understand the big picture behind iron condors and butterflies. Really, what are they there for? When it comes to iron condors, you can really dictate how wide you go. So the wider that you go, the less money that you make, but the more successful you can be, the chance of success meaning. So when we look at, let's just say Amazon here, and we take a look and we pull up Amazon, if I decide that, hey, I really want this thing to be successful, well, I could go selling puts and calls out of the money, or in the money here, at about 5-7%, right? I'm not going to make a lot of money because you're going really far, really wide, but you have a higher degree of success compared to maybe going in tighter. So let's do that kind of example real quick. I'll show you here at the 1600. Let's say sell an iron condor. I'm going to put this up right here. I'll go ahead and take a few of these older trades off for you for the simulations. And now we have kind of a 1600. We're selling the 1600, buying, let's say, on the put side, we get the 1600. Here we'll buy, let's say, the 1570, make that the live price. And on the call side, the current price is 1931, so we need to go way above that. So to sell that, and again, if I want to go and check the percentage-wise, I could go and look and say, hey, okay, well, my delta or probability in the money, probably around the 2,220 level. So I'm going to go ahead and sell that one. Wish I could just type them in, 2,220, and you're buying probably the 2,000, let's say 250, give or take. Okay, maybe 240. There you go. Okay, so now you can see that this one, okay, and we have a little bit of a lopsided one. So let's bring this one in right here. And now we're more balanced. Okay, so look at this. We have a wide iron condor. So my chance of success on this is fairly high because this stock can wiggle around here and I'll still be profitable. How profitable? Well, I'll make $215 on about a $1,700 investment. So that's almost a little more than 10% right there. So I make quite a bit of money there, just simply if that stock wiggles around and expires, in this price range. Now, that seems to me fairly useful because now you could go ahead and stretch this and condense this. Say, hey, I want to make a little more money. Okay, well, what do you do if you want a little more money and you're willing to take on more risk? Well, what you could do is say, go ahead, I'll bring this in from the call side, and I'll go to 2170, and that one's not traded. Let's say 2150. That one's also not traded. Let's go to where is it? 2120. Is it traded? Yes, it is. So now we'll go into this one, 2120, and call it 2160. 2160. We brought that in on the call side, and we'll also bring things in on the put side. So I'll bring things in, let's say 1750, and the one we buy for protection maybe around 1720. We've got to go 1710 right there. So now I make a lot more. So I make about $1,132 on about $2,800 of capital. So that to me is phenomenal returns. Now, the chance of this succeeding are way lower. Why? Well, because I've brought things in. Now, my theta decay here is a lot bigger, so that's the huge advantage. But if this stock wiggles around, I really only have about 100 points here and 100 points there of wiggle room, so about a 200-point range, compared to the other Iron Condor was kind of over here, 1600. Move it over, and this was around 2200. So I had an extra maybe 100 to 200 points of room. So that's kind of the big difference, is that this is where the Iron Condor shine, is that you can make them as wide as you want, but then of course if the wider you go, you make less money, but you have less risk. If you go tighter, you make more money, but of course you have more risk. Now, how can you turn this into a butterfly? And you might say, yeah, you can't turn into an Iron Condor into a butterfly. Well, what is a butterfly? You got two contracts at the same exact price. How do I make it a butterfly? Well, I take the ones I'm short and I bring them in. And let's say I go into the 1900 right here. So I'll go into the ones that I'm selling, the call side. I'll go back into this, the 1900. Let's just make it 1900 even for now. And the put side, the one I'm selling, also 1900. And voila, it is a butterfly. Now it's a little bit lopsided for now, and we are very, very spaced out very wide. So I could go ahead and bring some of these in to maybe 2130, maybe 2120, maybe even more, 2100 right here on this side. And I could bring the other side in. But check out this. What is the useful point behind a butterfly? Well, you capture theta really fast. If you want fast theta return, you want to be in and out of the trade in a couple of days, this thing shines. Look at your theta. Why is it more? Well, that's because you're at the money. The ones that decay the fastest are the closest to the money, or at the money. And because we're right there where the price is, you know, you could be in this trade 2-3 days, boom, and you're out about $200-300. You're profitable. Voila, magic. So anyways, this is where these things shine. Now, what you could do is, hey, let's say I'm a little skewed positive. Well, what can you do? Well, you can go ahead and bring one side or one leg tighter. So I'll go ahead and do that. So all of a sudden, look at this. I have, number one, a little bit skewed position to the upside. I'm directionally biased, but I still have a very high theta return. So think of it in that ways. How do you structure the trade to cater and work with the market? So this is what's interesting about this trade, is that it could still go down and you make money. It can still stand still and you make money. And it can even go up and you still make money. And it's got a fast theta return. So that's the advantage of these. So if you think, hey, we're going to hang out here for a couple of days and then we might explode up or down, well, this kind of gives you a little bit of wiggle room, and that, hey, if we're just kind of hanging around in the 50 or 100 point range and then we start moving up, this is fantastic. So anyways, that's how they can be used. And really, if you want to see kind of a hugely broken wing butterfly, you can even do something like this, where it's somewhat, just to show you an example, where it's somewhat like a vertical spread, but look at this. You're profitable if the stock stands still, if the stock goes up, or if it pulls back a little bit, which also, compared to a vertical, you get way faster theta decay. Now, the downside, of course, is it loses money very quickly here, and you have a lot more capital on hand, and that is because you have a higher chance of success since you're already putting on this position, and it doesn't even have to move for you to make money, but you have high theta returns. And even if it doesn't move in your direction, in a couple days or within a week, you're out and you make about $200. Fantastic, isn't it? All right, so that's kind of my point and thought on these Iron Condors and butterflies, and really when you would use them. So when would you use an Iron Condor? Well, when you believe the stock price is going to hang around kind of in a certain range. As far as a butterfly, when would you use that? Well, again, when a stock price is going to hang around a certain age. But remember, there's so many variations to these. Just like with an Iron Condor, you can skew it a little bit one way or the other. Just like with a butterfly, you could skew it one way or the other. So it's not just about putting things on always balanced. It's about understanding how the market's moving, understanding the trade you want to put on, and now tweaking that trade based on your needs, based on the stock, based on the market conditions as well. So I hope that makes sense, because it's not just about putting these things on, setting them and forgetting them and letting them expire. It's about tweaking them for the conditions that you have. All right, so thank you so much for joining me. If you enjoyed this video, be sure to hit subscribe on YouTube or get on my newsletter list, definitely by clicking one of the links right over here. Enter your name and email address, and that way you get notified as I release new videos. And of course, if you have a question, check out our website at tradersfly.com, and that way you get your question answered. Thanks again, and I'll see you next time.